The unanticipated economic growth and challenges in China. Historical background of Shenzhen's economic miracle. In 1980, economists might have underestimated the potential for economic transformation in China. Under the leadership of Deng Xiaoping, a small town named Shenzhen, situated near Hong Kong, was granted special economic privileges to engage in global commerce. At the time, Shenzhen was a modest town with a population of around 330,000, a relatively small figure considering China's status as the first country to surpass 1 billion inhabitants. Over the subsequent 40 years, Shenzhen evolved into one of the world's largest and most economically influential cities. By 2018, its GDP outstripped that of Hong Kong, a historic global commerce hub. Shenzhen now ranks as the 8th largest city globally by population, marking a significant shift from its modest beginnings just 4 decades ago. Is Shenzhen's growth unique? Shenzhen's rapid development is not an isolated case in China. The nation boasts hundreds of cities that are economic powerhouses in their own right, thanks to widespread adoption of similar economic reforms. These policies have lifted hundreds of millions out of poverty and made many consumer goods more affordable. However, this rapid growth has also led to domestic and international challenges. One primary issue has been the unrealistic expectation that such economic growth would continue indefinitely. Various social, political, and economic frameworks have become dependent on perpetual growth, leading to practices that favor short-term economic boosts at the expense of long-term stability. Now, 40 years later, China is grappling with the long-term consequences of these choices. Why are growth rates a problem in China? Why do growth rates that would be impressive in most countries pose a problem for China? Furthermore, why does a decrease in prices trigger concerns among economists about the country's economic health? How can a country with relatively low national borrowing face a debt crisis? And crucially, is this situation different from previous predictions of China's economic downfall? Personal financial circumstances. Regardless of a country's economic performance, individual financial circumstances can vary widely. In a globally interconnected supply chain, the pressures can feel overwhelming. China's economic problems, a disclaimer. Before diving into China's current economic challenges, it's essential to acknowledge the internal tensions the country faces, from proposed hostilities with technologically significant nations to human rights issues. China's rise as the second-largest economy has dramatically shifted the global status quo, formerly dominated by the USA. While some might be eager to hear about a potential collapse of China's economy, it's important to base assessments on facts. Just over a year ago, we discussed why China wasn't on the brink of collapse. Since then, the country has reopened after the most severe pandemic lockdowns. The hope was that economic activity would rebound, but the recovery has been slower than expected, with growth rates dropping to around 5%. Why is 5% growth considered a crisis? Many media outlets and economists view China's 5% growth rate as a crisis, but they often fail to explain why. While 5% growth is low by Chinese standards and follows a decade-long downward trend, it would be remarkable in most other countries. Advanced Western economies aim for 2 to 3% annual growth, and many struggle to achieve even that. The issue lies in expectations. If someone planned their budget around a 10% annual income increase but only received a 5% raise, they might find themselves financially strained. Similarly, China's economic strategies and investments were based on the assumption of continued high growth rates, and the reality of 5% growth has significant implications for the country's long-term economic stability. The compounding effect of growth rates. Growth rates compound over time, making a significant difference in economic output. An economy with a $1 trillion GDP growing at 5% annually will reach $1.65 trillion in a decade, while a 10% growth rate would result in a $2.71 trillion GDP. China's economy was built on the assumption of sustained high growth, and the current lower rates are insufficient to support the extensive investments made over the past decades. The ghost cities phenomenon. China's rapid growth led to the development of ghost cities, where entire urban areas were built but remained unoccupied. These projects were fueled by investments from government, companies, and individuals, all betting on continued economic expansion. A slowdown in growth could mean these areas remain empty, causing financial strain for everyone involved. The debt crisis. Real estate is not the only sector affected by China's growth slowdown. Infrastructure projects, trade deals, and international initiatives like the Belt and Road Initiative were all based on the expectation of rapid economic growth. China's national debt to GDP ratio stands at about 77%, but provincial debt and borrowing by state-owned companies add significant additional burdens. Provincial debt. Provincial debt is particularly concerning because local governments lack the authority to print money, risking insolvency. Estimates suggest provincial debt alone could be over 150% of China's GDP, pushing the combined national and provincial debt to over 200% of GDP. State-owned companies and debt. State-owned companies have driven major projects both domestically and internationally, often with less than stellar outcomes. The Belt and Road Initiative, intended to build trade partnerships, has led to significant lending that may never be repaid. Domestically, companies like the China Railway Corporation have overinvested, contributing to the country's debt burden. Household debt. Household debt, primarily directed towards real estate, has also surged. Many Chinese citizens invested in property, expecting continued economic growth. With cities now experiencing slower growth, these investments are losing value, adding to the country's financial woes. The deflation issue. China is currently experiencing deflation, where prices of goods and services are falling. While this might seem beneficial, it often signals underlying economic issues. Deflation can result from decreased consumer spending, either due to lower earnings or future economic concerns. This can slow down economic growth further, creating a vicious cycle. Conclusion. China's economic challenges are multifaceted, stemming from unrealistic growth expectations, significant debt burdens, and recent deflation. While the country has achieved remarkable growth over the past 4 decades, it now faces the long-term consequences of its rapid expansion. Addressing these issues will be crucial for China's continued economic stability and growth.
As always, do not forget to like and subscribe to our channel, All Things Money, to see more content like this.